Well, as I mentioned right before the break, here with a preview on how the bond market will react to the FOMC statement today. He was ranked the top-rated analyst for Treasury inflation-protected securities last year by Institutional Investor, and he is Michael Pond, interest rate strategist at Barclays Capital. Michael, always enjoy talking with you. Thanks so much for being with me.
Good morning, Betty.
Okay, so obviously, the question is, what could the Fed say today that could move the Treasury markets?
Sure. Well, a number of things could happen. As far as what we expect in changes in the statement, we do look for the Fed to recognize the more positive economic outlook that they were looking at their April meeting. And this morning's durable goods report was just one more piece of positive economic data that they'll likely mention. On the contrary, though, the economy remains on a tough footing here, and the Fed will likely keep its stimulative policy in place for, right now, longer than the market expects. The market got a bit ahead of itself after the payroll report a couple of weeks ago, started to price in hikes. We just don't think that that's in the cards, and the Fed will likely signal that they're going to be on hold at or near zero on the funds rate longer than the market's pricing in right now.
And the market's pricing in when?
The market's pricing in as early as December, which this year we just don't think it's likely. The Fed recognizes that there's plenty of slack in the economy right now, and even Dallas Fed President Fisher, who's on the hawkish side of the F.O.M.C., indicated recently that they want to make sure not to repeat the mistakes in the 1930s in the U.S. or the 1990s in Japan, where stimulative policies were taken away too early, causing a double dip in the economy.
Right, it might wash out sort of those efforts if they hike rates too early. But Michael, then as a Treasury investor, as you look at the markets, and what side do you fall on? Because as you were just mentioning, we look like we seem to be seeing some good stuff in the economy at this moment, and yet it's going to be a tough road ahead. So are you going to buy or are you going to sell Treasuries at this point?
Well, in the near term, we think you should buy the front end of the Treasury market, which again is priced for too many hikes too fast. Consensus expectations on the Fed have them hiking sometime in the middle of the next year and slowly moving up from there. A two-year consistent with that consensus forecast would be around 70 basis points. The two-year Treasury right now is right around 120 basis points. So we think that's where the value is in the Treasury curve. Further out, we expect continued volatility. Because of the uncertainty, the economic outlook, despite the improvements. So, for example, this morning, the OECD came out with a forecast raising their growth outlook over the next couple months, whereas earlier this week we got the World Bank downgrading their growth forecast over the next couple months.
That's right. I mean, it's hard to put all of that in context and figure out where you're going to stand. I'm just curious from your point of view, Michael. I mean, who do you weight more in terms of that outlook?
Well, we think eventually the economy is on a path to recovery, and we do look for positive GDP growth in the third quarter of a bit over 3%. Part of that is because of the recent legislation in the auto industry, the cash for clunkers legislation, which we do think will cause a reversal in the large inventory draw in the auto sector and get production ramping up again. That should put us on a more positive path. But still, GDP at around 3% means that slack in the economy, which is significant, will be removed, but over a long period of time.
Michael, for homeowners in the United States, this is a very key question. The Fed has not been able to bring rates down on the longer end of the yield curve, as you were just talking about. I mean, what can the Fed do about that?
Well, they could buy more treasuries. They could buy more mortgages. They still have an additional 120 roughly billion to go in their treasury purchase program. That's set to end at the end of September or earlier if they continue along the pace that they have been. Buying more treasuries could push rates down. On the flip side, buying more treasuries could cause foreign investors to be a bit skittish about buying treasuries because of the potential inflationary impacts of monetizing the debt.
But Michael, we've seen the Fed do that, and it hasn't worked. So what more could they do?
Well, they could encourage the Treasury and the government in general to change some of the terms of mortgages to make it easier to borrow and bring rates down that way. But, the Fed's in a tough spot right now in that the economy is on a bit better track.
Right.
So they don't want to do too much to create inflationary expectations down the road.
Okay. Michael, great to talk with you. Thanks so much, Michael Pond of Barclays Capital.